It's cooking time. Those with babies, it's baby nap time. And to everybody who's an audience today at the JSE, welcome. We do have some refreshments for you after today's masterclass and session. And would really like to take this opportunity to unpack a little bit of what today is about. Masterclasses are always great when there's masters of industry in front of you, and I'm joined by a very wonderful panel, which is going to be facilitated by Mike Brown, director at etfSA, and then also involved with the Investment Analyst Society for many years. Actively managed certificates, actively managed exchange-traded funds. What are they? How do they work? How do they trade? How do they operate? What uses would you find or benefit would you find from investing in them? These are some of the topics and themes that we're going to unpack today with my wonderful panelists that are joining me. Ben Meyer, who is with Prescient. We've also got Nick Petrez. He was replacing Johan Erasmus. He is with Standard Bank. We've got Gareth Stobie from Core Shares, now powered by 10x. And then we've got Aveshan Pillay from UBS. And amongst us today, it's quite an incredible panel that sits before us. And they're going to help us. And I think today's session online and also in person, please view it as very interactive. This is not a democratic story or political rally, so answers will be short, concise, and to the point. And I hope that you take away from it a better understanding of how AMCs and AMETFs trade here at the JSE. And that's a class we are very proud of lately, and it's been growing quite nicely in terms of new issuances and assets that have been gathered by these asset classes. And as we try align this asset class in this segment of the listings requirements to what is happening globally, particularly looking at the US as a model, United States. Today is their Independence Day, so I thought I'd mention that. And feel free to ask as many questions as you can. This session will be recorded and the recording will be made available post this, so look out in your inboxes for some information. And with that, I would like to hand over to the director, the facilitator, Mr. Mike Brown, father of ETFs in our country. Please give him a round of applause.
Well, thanks. As we're informal, we're going to keep seated, like all the rest of you, and try and go through this subject, I think, in an informal manner. But I want to make it as open as possible to our audience. We've got a very big online audience, and there's some very interesting names and asset managers involved that I'm quite surprised are actively wanting to find out about this new generation of ETFs, which are now being introduced. We all know what ETFs are. Hopefully we all do. They were started in 2000 with quite a simple ETF, Satrix 40, which just tracked an index, the top 40 shares in the JSE. And the innovative part was that it was a portfolio. You weren't just buying one company, you were buying a whole portfolio of shares. Now, even in those days, you could buy a portfolio of shares under an investment trust. But an investment trust always traded at a massive discount to its net asset value for various reasons. So what was innovative very often amongst the innovative elements of this is that you listed a tracker fund, which meant that it could trade in a secondary market. Up until then, you could only buy collective investments or unit trusts through the primary market, but now these trade in the secondary market. They were, in order to make sure that they did not have a net asset value discount or premium, you could create shares anytime you liked. Now, a normal company had to have a rights issue. It took you 6 months to get permission from shareholders to have a rights issue, but you could create or redeem shares every single day with an ETF. And you had in-specie delivery, so you could swap a basket of shares for the ETF or vice versa. So there's no reason if the ETF was exactly tracking an index, the ETF had to be physically backed by all the shares that made up an index, that ETF would trade at a different price to the index. In the case it didn't, you could swap the underlying portfolio of shares for your ETF, which meant that the minute there was a gap, the arbitrageurs would be in and make a fortune. Now, that never happened. There was never an arbitrage opportunity that was really open to people who were looking to take advantage of ETFs trading away from net asset value. So right from the start, these were quite efficient products. JSE allowed market makers, and it brought with itself the JSE as the underlying manager, or the LISP. How do you buy and register and hold your securities? Well, you do it through the JSE. So the JSE was the cheapest list in town and still is. So that was the start. Within a couple of years, we had commodity ETFs. We then went into the first foreign ETFs were listed on the JSE as under the ETF structure in 2005. We had actively managed, not actively managed, we had smart ETFs introduced 2007, 2008, when we started tracking not just indices, but certain characteristics like high dividend paying shares or fundamentally valued shares, the RAFI products. Then we had ETNs, exchange traded notes. So you didn't physically hold the underlying basket of shares, but you had an issuer who would guarantee that he would give you the return of an index or the return of an asset. So you had to look at the creditworthiness of the ETN, who issued the ETN. And from then we've moved through various other things like smart beta. And now this is just the next development in the history of ETFs on the Johannesburg Stock Exchange for the last 20 years. And what we now have is actively managed portfolios. We've always had passive portfolios, but with certain characteristics that perhaps make them not entirely passive. But now we fully open up to actively managed ETFs. And what really triggered this was the publication of the modification or amendments to the JSE listing requirements last October, October 2022. And following quite a long period of consultation with the industry. And so now we're into this new generation of being able to list a managed portfolio, effectively a unit trust on the stock exchange, having all the benefits of the stock exchange, tradability, liquidity, guarantees of your ownership and so on. And so this, I think, is a very important development. And I think it's great to have this panel. Now, Maurice has already introduced the panel, and I'm going to try and incorporate them, make sure that everybody gets a chance to answer questions. But I want to try and bring in, if possible, the audience, not only the live audience here, but our audience listening in on Teams or on Zoom, so that we can make this interactive and try and network as much as possible. So how do we kick it off? Well, actively managed products. The man on my left, Ben Meyer, had a lot to do with this in terms of drawing up the listing requirements for the JSE. So let's turn over to you, Ben. What was the intent and the purpose of bringing actively managed portfolios within the Section 19 of the JSE listing requirements?
Thank you, Mike. Look, it was driven by the market, by market demand. You know, ETFs have been well established. You've mentioned, Mike, that the JSE is potentially your cheapest list. You know, and for index tracking ETFs being around, well established, and I think it took a long time in South Africa, 20 years, as you said, for the trading benefits to really be realized of ETFs. So really, JSE was approached by some asset managers as well. Why don't we, you know, why don't the JSE have requirements for active managed ETFs? And that is where the whole consultation process then started. So yeah, it was driven by market demand to have more product. JSE obviously supports it because JSE wants more product. The challenge then obviously came to have a regulatory framework from a listings requirement perspective to make these things practically doable. And the biggest issue really was around the liquidity provision. Because as you mentioned, one of the big benefits for ETFs is trading on the JSE during the normal trading hours. Now, in your unit trust world, you can only buy, you know, transact once a day at a fixed time with the asset with the manager of the unit trust. In the ETF world, you can transact by various ETFs and instruments and AMCs and structured products all in the JSE on the same platform. It makes it a very versatile platform. But now the JSE, to have a product listed, requires that it must be liquidity in the underlying, in the product itself, because otherwise what's the point of having it listed? And that's where the big challenge came from the requirements perspective for active managed ETFs, because in the index tracking space, it's relatively simple because you track an index. The index is transparent. Everybody can see the index. So you appoint an independent market maker that makes prices based on what the whole market knows. and market maker provides liquidity. In the active ETF space, it's a little bit more complicated because a lot of active managers don't necessarily want to share their secret sauce, show what is the underlying constituents that they hold. So the JSE had to come up with a mechanism to allow trading without full disclosure of the underlying. And we can later go into more detail how that mechanism works. But that was a key challenge to solve. Of course, the JSE also allows active managed ETFs. And you have examples internationally where there is full disclosure on the underlying, and then it's simpler to provide liquidity from an independent market maker's perspective. So that was really the big challenge is solved for the liquidity, and the rules now solve for that. If there's a need to go into more detail, we can go into it later.
Okay, so now we've got those listing requirements. But the JSE, not being simple, solves it. Well, there's two different types. You can have an actively managed certificate, or you can have an actively managed ETF. So let's unpack those two different types. Perhaps I can start. I'm not going to go in order where we're seated here. We don't have to change seats, but let's go to Avish, because actively managed certificates is what you do. I mean, at the moment you specialize. You've listed 32 of these things in the last few months. Talk to us about what an actively managed certificate is.
Thanks, Mike. I think a good way to describe it, and as you rightly said at the beginning, we're talking about actively managed portfolios. The only distinction between a certificate and the fund comes down to the issuer and their respective credit risk. I think it's a very good, important starting point, because that ultimately drives the distinction between the fund solution, where an investor has right and recourse to the underlying assets, versus a certificate ultimately issued off a bank's balance sheet. That introduces concepts around the credit risk rating of the issuer and what would typically happen in the event of default. There obviously are some efficiencies to that type of mechanism in the certificate space. There are things such as time to market, which could be reduced when compared to a fund, but ultimately you're considering, how do I get exposure to the bank? In particular, where funds or investors have credit limit risk parameters or certain considerations in that regard, these factors become a lot more relevant and topical when distinguishing between the two solutions. I think from a certificate perspective, the efficiency that we've seen with being able to bring the product to market in a shorter time period has probably driven some of the growth that Mike has referred to, where it is a little bit quicker in terms of the funds. But I don't think it is a material difference now that there's a framework on the exchange for bringing these products to market.
Okay, so the actively managed certificate has a big benefit relative to the unit trust, that it's underwritten by a bank. So you've got an underwriter that says the product will deliver what it says on the package. It will deliver the performance of this basket of assets or this particular asset. Now, you need a big bank, and UBS has got a better credit rating than South Africa, and even better credit rating than some of the audience here. But we've also got Standard Bank issuing AMCs. Perhaps, if Nick, you could come in just on where you saw an opportunity for your bank.
From a Standard Bank perspective, if you look at the evolution, we've been involved in the issuance of ETFs and ETNs. For us, this was a huge opportunity to service our client base across the franchise, which is predominantly asset managers. And what an actively managed certificate is just another vehicle, as Avish alluded to, which allows asset managers or portfolio managers to deliver their product to the underlying client in a different format. So whether you want to make the analogy of the JSE being analogous to a LISP, it really is just an ability for an asset manager to provide their clients through a settlement process to buy their portfolio. And for us, that we saw huge value in that. So, that has been the sort of the growth vector of AMCs for Standard Bank.
Great. Well, so now we've got a couple of banks involved in issuing these notes, but you don't have to have an AMC. You can have an actively managed ETF. And also in our panel, our esteemed panel here, we have the one person who's issued an actively managed ETF in South Africa, which is Gareth Stobie from 10 times call shares or 10x call shares, whatever they call it nowadays. But You don't have an AMC, you have an actively managed ETF. What's the difference between an AMC and an actively managed ETF?
Mike, I mean, perhaps the way I can introduce the topic is to look at the traditional CIS market, which kind of dominates our savings environment in South Africa, where you have CIS funds that are obviously on LISPs, and advisors and different parts of the investment community are using those funds, and then you have the ETFs which are listed on the exchange. Within our business, we've got both traditional unit trusts, TIFs, another acronym, and we've got exchange traded funds. So perhaps it's useful to look at why would a traditional ETF issuer move into the active space, or how would an active manager managing money in a TIF move into the ETF space. So for a traditional active manager who perhaps has a traditional unit trust where they're managing the portfolio, moving onto the exchange means basically that you're opening up a new distribution channel. What is that distribution channel? Well, it's everyone who's buying and selling listed securities on the exchange. So the entire stockbroking fraternity, whether that's traditional stockbrokers or low-cost stockbrokers, online share trading platforms, and so forth. So it's basically a new distribution channel, a new ecosystem actually in terms of who the role players are, straight, and as I say, the stockbrokers and so forth. For the traditional ETF issuers, why would they move kind of upstream, if you will, into the active world? And the way that we saw that is an opportunity to bring exposure, to bring access to ETF investors that didn't exist before. So in other words, which were strategies that you couldn't simply invest in an index construct. And the one obvious opportunity for us was in the fixed income world, where large parts of the income, credit, and yield markets simply weren't available in an index construct, which was the previous constraint in the ETF world. So for us, it was an opportunity to bring a holistic income solution to market, something that you wouldn't have been able to do in an index environment, because you needed the ability to buy different types of exposure, and those types of exposure simply weren't available in income and index format. And it allowed you to manage cash coming into the fund or leaving the fund, as the case may be, much more dynamically than you would have been able to do in a traditional ETF format.
Thanks, Gareth. So now we've got what an actively managed ETF does and what an AMC does is it gives you access to a lot of different types of assets. You typically in South Africa could track a government bond index or an Orbey bond index, but in an income fund, you can track a portfolio which holds other sorts of debt. It could hold private debt, it could hold bank debt, it could hold corporate paper, it could hold inflation-linked paper. So you've got this flexibility of putting together a portfolio that gives you a different type of duration profile, a different type of risk profile to a purely bond fund. And AMCs, I think, have got even more flexibility because there's some very, very nice AMCs that have been issued here. You can buy luxury goods, you can buy biotechs, you can buy all sorts of things. So what the actively managed scope world does is I think it opens up listing a lot of products that are not traditionally just tracker funds or indices. And I think that's an important element in seeing the development to where the market will go. Gareth, just one final question from me, but an actively managed ETF, you do have to physically hold the portfolio. Is that correct? Because you don't have a bank backing you up to say that we will deliver the performance. You deliver the performance by having a portfolio that we know about that's relatively transparent.
That's right. So the fund that we listed was a traditional CIS fund, a fund in securities, regulated and governed by the CISCA Act, like all of the other unit trusts out there. The big difference was that it also complied with the JSE listing rules, and so the two key things which Ben touched on earlier was making sure that we publish the constituencies of that fund so that the market knows what the net asset value is at any point in time, and market makers can make a trade around the NAV, and then the cash and creation process as well was critical. The primary market to secondary market process. Those were really the key differences.
Great. Okay. Well, so now we have this environment where we have these actively managed funds. The portfolio is a part of it, but the big issue with ETFs, and that's why I had a bit of a long introduction, is so that what's beneath it is quite it's like an iceberg. Only 10% pops out the water. The rest that's underwater is quite complex. It's quite structured. And if you read the listing requirements, the JSE, you realize that you need a lot of knowledge and technology and services and all the rest that support that ETF. Now, each of these gentlemen here, and I apologize for the fact that it's only gentlemen, when we put the panel together, the JSE and the IAS, we thought, well, yeah, the blokes, let's invite them, and we should have had a couple of girls here, but we'll do it next time. But this panel all are running platforms that can structure and bring these things to listing. So they can provide all the services for you just to bring your portfolio along or to invest in what you want to invest, but they'll do all the complex work behind that. And perhaps you can kick off from this, Ben. You know, how do you see the sort of platform service that Prescient offers?
Mike, the issue is, as you rightly say, when you have a listed product, there's a little bit more that you have to do as to an unlisted product, you know, and it's also relatively expensive to list on the JSE. So as opposed to having a unit trust where you only pay fees to the etfSA. The first thing I just want to mention, what's important to note, to pick up what Gareth said earlier, is that in terms of the JSE listings requirements, only active managed ETFs, that's collective investment schemes, is currently allowed. So you could probably do more weird and wonderful stuff you can definitely do more weird and wonderful stuff in the AMC space, but in the active managed ETF space, because it's a unit trust, you regulate it in terms of FSCA requirements. So issues like board notice 90 that you have to comply with and so forth. So first and foremost, you have to have the product structured as a unit trust. So there's FSCA fees, and then you have JSE fees as well on top of that. So to set up, and the second thing that's important is from an FSCA requirement perspective, you can't use a existing collective investment scheme and simply list it. Because of the nuances around the trading side of things and providing liquidity, you've got to have a separate scheme in ETF securities that's approved by the FSCA. So for an existing asset manager that's got a management company, that's got an approved unit trust scheme, you can't just simply list that. So you've got to duplicate that whole structure. Now, if you're going to use active managed ETFs because you want to get additional distribution capability, it's expensive to duplicate the whole structure. It's not only the listing fees, it's staffing issues. You can use the same management company, but you've got to have a new scheme. So, and a lot of those portfolios, active managed portfolios, tend to be much smaller portfolios than index tracking portfolios. Now, typically, as a rule of thumb, you know, for an index tracker to be efficient from a listed product perspective, you probably need asset sizes from 500 million to $1 billion. $1 billion is probably the sweet spot if you do it as a standalone. Now, because of the demand, there's a huge demand for smaller funds, you know, typically the 50 to 100 million to 150 million, where it's inefficient to set up a whole ETF structure. Now, to fill that gap, Prescient is providing a white label solution, which is similar to what you have in a unit trust space. We've been doing it in a unit trust space for quite some time. And the white label solution effectively is all that the active manager needs to do is to manage the actual portfolio. So what Prescient does from a scheme perspective is it provides the Manco services, it provides the listing services. We've established an entity called Prescient Structured Product Advisory that assists fund managers to bring their products onto our platform and onto listings. So
Thanks,
the benefit
you
of that.
explained that nicely. And
Thanks, Mike.
Done enough advertising for Prescient. Let's give somebody else a chance. Alison, I think in the 32 AMCs you've got, not to mention all your ETNs where you have a whole lot of portfolios, most of them tracker funds. But I think just in the 32 AMCs you've got, I think there's something like 20 different asset managers that have bought those portfolios to you. So you bundle that all up and you provide the service, the platform in which this thing can all be operated. So you don't have to be an expert in the whole structuring, doing the listing documents, getting permission from the JSE, getting legal approvals, all the rest, that's all done by the platform. Is this the way we can understand what really you offer to UBS?
Like, I think that's exactly the way to describe it, and to maybe give a one sentence pitch of what the product or solution at a bank perhaps is, and not just UBS. It's that you actually afford the portfolio manager the ability to focus on their core responsibility of investment and portfolio management. Everything else is outsourced to the issuing entity. And I think in that one sentence, it really captures what you've just described, Mike, in that solution. I think the platform from a UBS perspective really serves to provide global market access to the South African market and South African investors. And that talks to the demand that we've seen from our portfolio managers on the platform and why they've listed solutions on the local market. I think the guys here have covered the point around distribution, and you can connect that global market desire, global market access to the distribution point that's been described.
Great. Okay. Nick, I mean, is the Standard Bank one, is that also because a platform? Because I see you've got 6 different, you're down to AMC's 006 now.
Yeah.
You've got 6 different products. The next one's going to be 007. So you'll have to launch it with glamorous girls and Aston Martins and things like that to make the point. But
ex-tenants, huh?
You offer the same thing. I mean, what you're doing is the same sort of story, isn't it?
Absolutely. So you had the prescient sales pitch on the active ETF, and then truthfully, Version, our business is not too dissimilar. A bank issued AMC is exactly the same principle behind, for want of a better word, a one-stop shop for the portfolio manager. You've got administration, you've got execution, you've got custody, and then you've got distribution. I think the one point I did want to highlight is that you made the point about the FSCA and CIS structure overseeing sort of active ETFs and ETFs. The same construct pertains to AMCs. So in the JSE listing requirements, in order to manage an AMC, you have to either be an approved FSP with a Category 2 license or a member of the JSE. So, from a prudence of management perspective, that mandate that's approved by the FSCA that then comes through the AMC, that has to be governed and managed on the same terms and conditions.
So is there some element of segregation that the asset manager, let's call it the portfolio manager, asset manager, has to be a licensed FSP or licensed asset manager in one form or another? And that's a third party, but the issuer can't be the same person. The issuer has to be a separate entity. So who issues the product under their AMC, the bank underwriting, and who's the asset manager, those two are separate. I think that segregation also is quite a good protection for investors. So now, having said that, that is correct, is it?
Absolutely.
Now, Gareth, your story doesn't have to be that. I mean, core shares, are you going to bring third-party investors through in terms of AM ETFs?
Mike, we may actually, but with a slightly different view on it. I think where the 10x model is moving to is that we would like to support builders of solutions who are approaching those building of solutions in a contemporary manner. And by contemporary, I'm going to go core satellite, where they see a strong use case for indexation in their business, but they also see a use case for other exposures as well, be that active managed portfolios or certain asset classes that they can't just simply buy an index. So where they're coming to us for a large portion of that solution, then we will house a product for them. But we're not planning on simply white labeling ETFs in the same manner that Prescient might, for instance. So it's more of a sort of solutions mindset. We'll do a portion of the implementation for them.
Great. So then let's look now at the investors. I mean, we've used this term a couple of times, white label. And white label, as we understand it from the unit trust industry, is you bring your portfolio, you manage the portfolio, and this thing then goes through a unit trust or Cisco structure. And the JSE is now doing this. In other words, JSE is saying you can now list a white label fund. So I think that white label is important for 2 reasons. One is, as an issuer, an asset manager say, well, I want my portfolio now to have a big distribution. And the distribution now becomes a JSE. It's all this. people who invest on the JSE, it's the stockbrokers, it's the whole structure of being on a public market. That's the one side. The other side is, though, does this open up to different types of issuers? Because we hear all the time about funds being brought to the market, the private equity funds. This morning there was a talk about a food fund, superfood fund, where the manager is raising money to go and invest in agriculture in South Africa, saying the land bank's no longer there to do it. Can these sort of funds also be listed? Because I see opening up to, you're looking to raise capital. And what better way to raise capital than through a public market with a number of investors that are involved in the JSE? So there's two issues. One is, who do you think the issuers will be going forward? And I don't know who we can start with this one on. Maybe Nick, you can go with it. Where do you see issuers of products under these actively managed listing requirements coming from?
I can see Adele's getting a little bit nervous in the back here. So firstly, I think we should make the distinguishment between issuer and portfolio manager. So I think in the scope and space of Section 19, issuer is defined by ourselves, say banks or Manco. So I think that's sort of the first important thing. I think what you're asking is what other types of asset classes or portfolio management strategies can come to market. I think at the moment we have to work within the framework of the amendments to Section 19. And those frameworks are quite clearly defined by the Financial Markets Act in terms of what can and can't be bought. So it's predominantly going to be, at the moment, referencing listed assets on an exchange with some of the benefits in the fixed income space. Whether that grows into private equity, hybrid assets, a lot of that's going to be defined in sort of the future potential amendments to Section 19.
Okay, so perhaps that was an unfair question because the JSE has got these other boards which are trying to attract new capital, private equity and all the rest, but perhaps that all being wrapped together and in trying to raise capital through these various mechanisms. So perhaps let's just go back to looking at the white label story. The biggest issue of unit trusts products in South Africa is a white label fund. They've got more unit trusts listed than anybody else, the BCI situation. Do we see similar types of organizations setting up to do listed white label portfolios on the JSE? What's your view on this, Avisham?
I think it's a very interesting question that you actually asked, Mike. I think with respect to how the industry evolves, I think will be driven by two factors. The first is investor access, and we've connected those dots today around the JSE being a platform, distribution as a key element. I think the second factor, probably more important, is around cost. And in a world that at least I see from our perspective, where technology is such a huge component to how the bank thinks about solutions or how an issuer thinks about solutions, cost becomes a huge consideration. And I don't want to say there's a race to zero, but there's definitely margin compression that we've seen in the industry on portfolio manager fees, on issuer fees, on platform provider fees. I wonder, and I might not have the answer for us today, but I wonder whether platforms have the ability to evolve for what the future needs to deliver to those two aspects, both investor access as well as costs. I think the South African market is very well developed from a financial services perspective, from a financial products perspective, but we're seeing increasing demand for diversification. We're seeing increasing demand for product solutions. And I think I'm listening to the words that the panels used today in describing the different products and how they think about it. But the themes are the same. I think there's an appetite for something different. The distinction comes down to how you deliver that in the future.
Okay, so you raise a good point. My next question was going to be on cost, but we already got to it. because you don't want to have too much of a negative impact on the asset manager by him going out there and coming up with very good portfolio solutions, because an active manager must go out there and perform. He's looking for alpha, but you destroy his ability to perform because of high costs. And I think this might be the one area where the ETF structure, particularly using these platforms which can bundle and put together, you get the economies of scale coming from a platform, a way of getting very competitive from a cost point of view relative to the traditional, perhaps unit trust or segregated portfolio structures we've seen in the past. Do you have anything you'd like to add on that, perhaps, Gareth, if I can ask you?
Well, one thing I will say is that if you are in a kind of diversified financial services business and you walk from meeting room A, and meeting room A is a team of the Lisp guys, and they're talking about Lisp World and FinSwitch and their daily settlements and what they're doing on the list from a programming and reporting and client servicing perspective. And you listen to the lingo, the role players and the utilities in that room. And then you go to meeting room B and it's the stockbroking room, and they're talking about Straight and the custodians and how their world works and reporting. And it's sometimes feels like oil and water in terms of the terminology, the role players, some of the regulation involved. And that's been a major inhibitor in terms of the growth of listed products on Lisps, actually. So one of my kind of bugbears always is why the Glaciers and Alan Greys and 91 Lisps of this world are not more seamlessly buying listed securities. And it's because these two environments have grown up, if you will, in very separate ecosystems, different terminologies, different role players, different ways of thinking about things. And so hopefully what we're seeing now is some sort of convergence of those two worlds. And it's going to take lots of hard work. It's going to take willingness of programmers and back office people to actually kind of unscramble that. But that for me is a major challenge in the industry, is just how separate those two worlds are. It would be nice to see them coming closer together.
Yes. Now, of course, there's two completely separate worlds, as we all know.
Yeah.
We try and promote ETFs to trustees and to managers and to institutions and so on. They're used to the world of the old-fashioned technology, and there's big advantages in the sort of technology that this stock exchange like the JSE brings to the things going forward. I know Ben loves talking about costs and stuff like that, so he's got to have a chance to have his say on this.
Well, you mentioned Lisp, you mentioned JSE. I mean, JSE is another distribution channel. So effectively, the way I see it, Mike, is that the JSE competes with Lisps. So yes, I know a lot of ETF providers and others want to put products, listed products on the list, but it makes sense to some extent because the end client wants to have one area where you can see your whole portfolio. But it's to some extent there will be some sort of list can accommodate for both. But the way I see it is maybe a little bit different. That you've got a platform which is the JSE. If you compare it overseas, you've got exchanges like the 6 Swiss exchanges, got huge amount of structured products, AMCs, whatever. It's a massive distribution platform that competes directly. So if one talks platforms, you have to look at what can you get on the list, but can you get something similar? Will the JSE in future potentially threaten the existence of Lisp? That's another question that can be asked. It's not currently the case, and it comes back to cost. If it's a more cost-efficient distribution channel, and you can get more out of it from an investor perspective and from an asset management perspective, that will determine what platform you want to put your products. From a product structure perspective, it is definitely more expensive to have a listed product, except the AMCs. The AMCs is a very cost-efficient way to bring portfolios to market. The ETFs is slightly more inefficient because you double up on cost. You've got the etfSA cost, as I mentioned, and you've got the JSE fee. So then you've got to weigh up the benefit of that distribution. So you've got to weigh up the benefit of JSE distribution versus Lisp cost. And that is really where the discussion should be.
All right. Well, I mean, that's a good issue that you've raised, and I think that's really the critical issue. We've got technology against access, against distribution, and then looking at the new opportunities that I think are offered by being able to structure actively managed portfolios in terms of using these sort of mechanisms. I think it's probably time now to, without us dominating anything up here, but to perhaps open up to the larger audience that we've got. We've got some people attending here live, so we'll open up to them first. But if you're listening in on the presentation and on the discussions through our Teams facility, I think you can put your hand up. Or you can send us in a question and we'll try and answer those. So let's get to the live audience first. Does anybody in this room like to ask any specific questions to our eminent panel? We've got a roving mic.
Evening, Mike. Can the guys maybe tell me what experience we've had in terms of the distribution on the JSE? The potential split between institutional investment into these products and private client investment. Have we attracted private clients in?
First, from a Standard Bank perspective, we would most certainly say that the predominant adoption has been private client. So we've had portfolio managers looking to implement certain types of strategies, and those have been bought through the private client network. I think as this product evolves and becomes better known, I think the institutions will adopt it in some way or form, whether that's DFMs. I think there's quite a lot of scope for that.
Thank you.
Yeah, I think maybe from my side, depends on how you define an institution. So if you're talking about other asset managers, I think, some of the single commodity products, which like the banks have issued, have been very popular with other asset managers because they fulfilled that access point for a particular exposure that they couldn't otherwise get, and it was easy to access as one security on the exchange. But they're less likely to buy someone else's active strategy for obvious reasons. If it's an institution like a pension fund, then they should be, I know Mark's worked very hard in the industry trying to promote access to these types of products. They should be making much more use of listed products, definitely. And then DFMs, I think somewhat constrained by the whole LISP story, because a lot of them operate almost exclusively in the LISP environment, where they're running model portfolios for IFAs who are already in that LISP environment. So that's been their constraint. But your question's wise from a point of view that it is horses for courses. You've got to think very carefully of what exposure that you bring to market and how does that fit into your distribution strategy. Because if you're not thinking that through, then you're going to end up bringing the wrong product to market and selling it to those who are actually not really interested.
Yeah, thanks for that, Gareth. Thanks for the question, Bruce. We must also remember that the JSE is dominated by institutional trading. The amount of retail trading on the JSE is very small compared to the institutional use. So this is your market. The institutions are using this exchange. You've got to look at how do you get to those institutions by offering them product that they can consider alongside normal equities. Keith, you next in line.
Super, thanks, Mark. So there's a lot of captive money in South African Reg 28. Now, I feel in terms of active ETFs, we know what the answer, and it'll be likely, correct me if I'm wrong, there'll be a see-through principle, and the underlying assets will be, and that's how it will be allocated in terms of Reg 28. AMCs are a little bit vaguer. Do we have neater clarity on how they'll be treated? Is there discussion in the background? Because effectively it's a note of a bank balance sheet. So is there even see-through into the underlying, not in the eyes of the investor, but in the eyes of Reg 28 and in terms of the captive money in South Africa?
Thanks, Keith. Good last question. Evershan, do you want to tackle that first, please?
So I'm happy to give a view on that. I think from a Reserve Bank perspective, I think the rules are pretty clear with respect to the reference underlying to any type of bank issued product. And if it is foreign as the reference underlying, then the note or product would be foreign classified. So therefore marked off against a foreign investment allowance. I think it was an important and very key consideration for investors, say 3 years ago. With the change in Reg 28 last year, we've definitely seen that become less of a concern, as investors are happy to use onshore rands and get their foreign exposure on the JSE, subject to the 45% limit that's now in place.
Thanks, Keithy. We must remember that within the listing requirements, the issuers, an AMC or an AMETF, are required to publish an NAV. They can do it on a daily basis, or they can elect to publish their net asset values on, I think it's quarterly. Is that correct, Gareth?
Well, yes, the semi-transparent, it's every 90 days, and then
every 90 days, every quarter.
3-day lag after that.
So you do know what that underlying portfolio is, because the net asset value will give you information on those portfolios. They're required to issue fact sheets on a regular basis. So it's not as though these portfolios are going to be invisible. They are quite visible. You've got a fairly good idea what's in those portfolios, and you have to have that. You can't trade something if you don't know what the underlying value is. So I think, but that's probably where the investors could play a role in saying, I really want to know what's in this portfolio, what's in this structure. And I think Reg 28 is a good example of where one, as a pension fund trustee, you're required to report on a very regular basis, at least once a quarter, but very often your requirements as trustees are more onerous than that. Exactly what are you holding and how much have you got within each of those buckets of Reg 28. So I think this requires transparency. And I think the ETF industry is always showing great transparency. And hopefully this will continue. Any more questions in the room?
I shouldn't really be clogging the mic, but on the back of that question, one question I would have is, with the ETF structure, the look-through principle assumes that then that investor holds the underlying in their name, or is entitled to the underlying in some way, shape, or form. With AMCs, is that the same case? Because it is coming off a bank, and you can apply the look-through all the way down to the underlying, but at the end of the day, the investor doesn't have recourse to the underlying, or do they have recourse to the underlying?
So maybe I'll sort of echo Avesh's comments. I would agree with Saab's view in the manner in which they treat the note. I think the distinction between the fact that it may be on a bank's balance sheet and that you don't have recourse to the underlying, I think the practicality of it overrules it. And the sense is that I'm a portfolio manager, there's bank issued note, and I instruct you to go buy 10 shares on the NASDAQ. The bank actually goes and buys those 10 shares. Now, whilst they sit segregated in a balance sheet of ours, those are for the benefit of the client. Otherwise, we would be unhedged. So I think the layer of the bank balance sheets and using our macro prudential limits as opposed to the prudential limits of Manco, Saab sees it in the same light.
Okay. Is there a possibility that we could get some idea of who would like to answer questions from our broader audience? Have you got any questions, Jamie?
Yep. So there was one which has just been answered. Can you explain the difference of the role of a market maker on AM ETFs if the holdings are disclosed in arrears, agent model?
I'm happy to go that one, Mark.
Yeah, please.
So there's two ways you can provide liquidity. One is you disclose on a daily basis the portfolio composition file. That is what CoreShares is doing with their ETF. Then it's very clear what the underlying constituents are on a daily basis. It's completely transparent. Therefore, you can then appoint an independent market maker that provides liquidity because they know how to hedge themselves because they can see the constituents. That's the one model. JSE's rules also allow for a model which there's no transparency on a daily basis. And as I've mentioned earlier, because certain portfolio managers wants to, protect their intellectual property. So in that basis, the JSE still requires that there must be intraday liquidity. So who provides those prices? So practically what happens is that the fund itself becomes the buyer and the seller of the underlying units. And how does the fund do that? It appoints an agent, which is a stockbroker, JSE member, and it then buys and sells via the agent. So the agent, as a JSE stockbroker, it's just what it is. It's the agent buys, sells a behalf of the fund, takes no balance sheet risk, as opposed to a market maker that takes balance sheet risk. So the market maker can hedge himself, can hedge the balance sheet risk because the underlying is disclosed. In the case of the agent, the underlying is not disclosed, so the fund buys and sells on a daily basis. Of course, if that happens, it's similar to what happens in a unit trust world, because the fund issues units on a daily basis when there's demand for the product, or cancels units if people sell back to the manager. The only difference here is that it happens intraday. So there's much more trading where unit trust happens once a day. So the practicality thereof is that the manager got to do a daily creation or redemption of the underlying units, which based on the total net buys and sell of the day. And if you go and look at the standardized trust deed as prescribed by the etfSA, that daily creation redemption is then done at the average value of all the trades that happened through the day. So that is the difference between the agency model and market maker.
Right, thanks for explaining that. Anybody else want to contribute any further to that? Right, do we have any further questions on the?
Yep. So next one, are there any limitations or restrictions on the underlying instruments that can be included in the ETF or AMC, i.e., could instruments listed on the CTSE or private equity be included in the underlying assets?
No.
Cool.
The answer is, look, I can speak for the ETF side. The ETFs are collective investment schemes. So Board Notice 90 is still applicable. Board Notice 90 determines what you can and can't hold. So under Board Notice 90, you can't hold private equities, so it's no. In terms of the AMC side, if I talk about the JSE requirements, is the JSE, because AMCs are distributed to retail investors, the JSE generally applies the principle that whatever retail investors can buy in the OTC market, they can buy in the AMC. So if you can, for instance, buy like unit trust long-only portfolios, if AMC holds a similar type portfolio, that's acceptable. If you can, retail investors can buy RIFs, retail in investment hedge funds, which can have a long and a short in the portfolio. So the JSE, I mean, the Standard Bank issued some of those products. The JSE allows for that as well. So that's a general principle that's applicable. A private equity at this stage, no. The answer is no. You can't hold that in a portfolio.
Right, thank you.
I'm not sure the next one can be asked because it's not available at the moment. So yeah, that's pretty much what we have.
All right, so
I'd like to see that question.
Yeah, let's bring that one back later. Anybody want to put their hand up or anything like that? We can probably see you on screen. Have we got somebody in the audience who wants to ask a question? Arena Fisser.
Yes. I want to go back to the issue of the disclosure and the transparency. And this is specifically to Avashen and to Nick. So from an AMC perspective, who is primarily responsible for the disclosure? Not of the net asset value. I almost want to say that's the easy part. It's about what's actually in the underlying portfolio. I would assume that as the issuer, the bank has the primary responsibility, but it is the portfolio manager who would actually know what they've got in the portfolio. So who should the investor go to as the primary source of disclosure of what are they actually investing in?
So maybe I'll go first. I mean, I think that both bank, so in the instance either Standard Bank or UBS, we would be the custodian of those assets. So by way of example, in Standard Bank, we use our prime broking business. So when a portfolio manager gives us execution orders of a portfolio, those are executed and they sit in our prime broking business, annotated, call it AMC 1 or 2. So 1, as bank, we have sight of that. 2, under the JSE requirements, we have an obligation to fulfill what's in the pricing supplement in terms of saying at the end of every day, those portfolio managers get those files so that they know what their execution process. Up, or if it's the issuer, then they sort of resonate with that. And I think having that information in the public domain, for example, the website, gives people that ability to access the information in the shape and form that it's disclosed.
Thanks, Avishan. I think we keep coming back to this point of liquidity. And that's really where a market does provide liquidity, because if you take, we're not saying anything bad about unit trusts, but they only trade once a day and that price stays for the rest of the next day. So you're really only pricing these things very occasionally. On a stock exchange, trade happens all the time. So if somebody now wants to sell or wants to buy that portfolio, they can put a bid or offer in on the market. And the manager, the asset manager, doesn't know this person wants to buy their stock, but that happens through the stock market. So it creates liquidity. The market itself creates liquidity, or at least gives you an indication that there are buyers or sellers of your stock. And I think that's very important, where if you only have a primary market, you have to deal with the issuer. Who knows who the issuer is? And you go through your broker, and your broker lives in Pofadder, and he phones the head office in Bloemfontein, and Bloemfontein phones Cape Town, and Cape Town says, we got some guy who wants to buy or sell. That can happen instantly on a market. So I think the liquidity that a market provides, I think, is very important, because it's not only by providing liquidity to the investor, but it's also a signal to the issuer as to what the interest is in their products. So the liquidity factor that is provided by, I think, these actively managed, whether you're going to call them white label portfolios, you're going to call them bespoke portfolios, on an exchange, I think will over time become a critical factor in the development of the industry. Do you have any more questions there, Jamie? I see there's the odd.
Yep. Bruce Anderson raised his hand. You're able to unmute, Bruce, and ask your question. Maybe there was an error. Okay.
Who was that?
No, it looked like a raised hand, but it has been removed.
It's been removed. Okay.
Yeah.
All right. Well, I think, are there any other questions that we have in the audience? Yeah, we have one in the front, Mr. Tim Lambert.
Private.
You got a microphone there.
Oh, okay. From a private investor's point of view, who say wants to do his own choosing of funds or collective investment schemes, and is looking at a conventional unit trust in comparison to the new managed ETF. what could he expect to be the differentiating factor or factors that would lead him to choose one type or the other? I'm thinking that.
Well, apart from investment performance and returns, which is traditionally what makes you choose one manager over another, have you got any other comments on that, the panel?
Well, if I could just add a bit that if one's looking at costs, let's say very sensitive to costs, initial costs and ongoing charges, the difference between those for equivalent funds or funds that have similar mandates, how would you choose? What would you look for?
Well, one of the requirements, the listing requirements, is that you must publish your TR. Otherwise, what are your costs? And hopefully those will be fully disclosed by the ETF business, as I think is the case with much of the unit trust business. So I think the information you're looking at to make a decision is there. And the disclosure, as Narina's asked, what is the disclosure? Well, the disclosure is there. You've got fact sheets, you've got daily net asset values. You perhaps are a little bit more reliant on what is the manager telling you, whereas with an index, you know what's in an index, you know what's in the top 40 index and what the weightings are. So there are some elements of disclosure, but I think over time, what will make you choose is whether you like the fact that these are quite innovative in terms of what they give you access to. And I mean, Gareth's AMETF, I think, is already very innovative in the South African context, and I'm sure we'll see others of those. But I think in due course, what you'll also find is that the liquidity and things like that will make these perhaps easier choice than perhaps traditional investments. But have we got any other questions? Because I want to now start wrapping up. Yes, sir.
Maybe to add to that, it's also a question of convenience from a private investor perspective.
Yeah.
Cost is the one thing, but it depends from individual to individual. If you've got a small portfolio, it doesn't make sense to go and buy it on a JSE. Your cost is going to be too much. But if you've got a reasonable portfolio, a couple of 100,000 rand, a couple of million rand, and you manage it through your BDA account with your broker, if you're a controlled client with your broker, just the convenience of buying the similar active managed ETF, the same exposure that you can get in a unit trust on the exchange with all your other individual shares that you hold, counts for quite a lot. And the trading part of it, yes, you're going to pay your broker, the fees that you pay your broker, but it's that convenience of having effectively the same convenience the LISP offer. You have the convenience now of having your whole stockbroking portfolio in your stockbroker. So it depends from client to client. A lot of clients, retail clients, it will definitely not make sense to buy the active managed ETF. It will make sense to buy a unit trust that sits on a platform via LISP, or you buy the active managed ETF via a LISP or some other route. Because for very small trades, the JSE is just not that effective. So the demand really is more obviously institutional we talked about, and then sort of high net worth and wealth clients make perfect sense to trade on the JSE. And then the net cost should be cheaper than accesses otherwise.
Okay, well, thanks for that answer, Ben. It's I think people like Easy Equities and Investor Hub at etfSA will say that we can trade at a significantly low cost as well. But let's not go there any further. You're going to be the last question that gets asked. So over to you, sir.
Thanks. I think on the matter of costs, arguably one of the biggest benefits with ETFs coming to market was that the issuer only had one bite of the cherry in terms of pricing it. And so invariably, the big benefit of ETFs was that they priced super aggressively, a hybrid between where a retail investor would get it and where sort of institutional clients would be priced. Are we seeing similar kinds of costs in AM ETFs? Would the average investor also benefit on the listed product?
There we go, Gareth.
I'm happy to go.
Yeah.
Well, the question is,
I think it was aimed at the MC guys rather than ETF guys.
ETF side.
Certainly on the ETF side, you're right. I mean, we've moved to wholesale pricing straight away, and that has been aggressively priced. I also wanted to come back to the earlier retail comments. I think as an industry, we probably do ourselves a disservice with this constant product proliferation. I mean, I bought the Sunday Times for the first time in ages the other day, and I was paging through the financial section. The stock section was maybe 2 small columns these days. You turn over to the unit trust section, it's like a 3-fold thing that you have to keep folding over. So I do feel sorry for the average retail investor trying to sift through all of this. Where the active ETFs have probably been helpful, and the AMCs as well, perhaps, is that what's now possible is solution funds, so balanced solution funds that drive a particular outcome, whereas before the ETF industry was just lots of different building blocks where you had to build your own solutions. So maybe just to weigh in on a point there. So there is that aspect coming through as well. Yeah.
Ben?
Yeah.
You're gonna
No. Look, the only thing I want to add on that is that the big difference on the JSE traded ETF is that there's no differentiation in cost. Everybody pays the same. If you're a retail investor, you pay the same as an institutional investor. You know, so if you, to Gareth's point, you want to attract retail, I think institutional investors, what they've done, you price it accordingly so retail investors can benefit. So yes, there should be, in time, benefits flowing through to retail investors, but you get exactly the same product institutional trades.
Good. Well, I think Gareth led me into my final question. You know, you normally as a panel, as a chairman of a panel, you normally say, "Well, here's your last final question. I want in one word everything," but you know, you can give us more than one word. And I want to ask, what do you think is going to happen next in this active space? Gareth already said he sees solutions, providing solutions, whether it's for pension funds, whether it's for different types of investors, through the flexibility of these structures. What do you think is going to be the next development, Ben?
I can't really comment from a product side, Mike, because we just provide the platform for asset managers to come in the product. But what I see from an ecosystem side, I see that there's definitely going to be, we talked about the distribution, there's definitely going to be more pressure on LISPs as a distribution. And there's no, for the first time, I think we're going to move to an environment where the JSE becomes a serious competitor to LISP, because you can have the same stuff listed on the JSE that LISPs offer. So I think from that aspect, I think that watch that space is interesting developments coming there.
Yeah, so don't start a LISP unless you really have to.
Maybe.
Nick, what's your final comment?
I think that you probably going to see some, you used the term weird and wonderful AMCs. I think they're going to be highly regulated, still weird and wonderful within the construct of certain regulation. But I do think, again, by bringing those types of strategies to this distribution network, I think it's going to be well received across the broking network.
Final word, sir.
I thought I had my
Okay, we'll skip you. Let's go to Havisham.
I think I definitely agree with Nick. I think there's going to be evolution in the product suite. I think we can already see some of those things happening, and I see it in 2 places. The first is having offshore managers wanting AMCs in South Africa to attract AUM from the existing South African managers, notwithstanding Reg 28 changes. And I think that weird and wonderful piece is where it gets exciting. I think that's where we'll see client demand, investor demand, forcing an evolution to the product suite. And I think potentially also evolving how the regulatory space looks. I think that's important. We've seen the evolution in the space thus far. I think there'll be some changes to that as it grows and as the industry grows.
Right, thank you very much indeed for that. Perhaps I could just, as a final word, just thank the JSE for making the facilities available to us. Adele and her team, Linda and her team, our audiovisual people. This is a great venue. We really appreciate what you made the facilities available to us as a society and to our extended membership base that have been able to listen in on this. And I did hear a promise that you're going to give us a drink and a Maori biscuit or something afterwards, which would be great. So my thanks, I think, on behalf of the society for being able to use these facilities. And perhaps, Maurice, can you Perhaps I'll give you the final word as is from the JSE.
Thanks, Mike. Thank you all for attending tonight and this evening. It's been wonderful to have you, and the panel has been amazing. As I told you, we do have masters of the industry with us, so if we can give them a round of applause, that's wonderful. As you know, as Mike mentioned, we are the JSE. This is a privilege for us to also host you today. Since we caught you just after work and before dinner, we have put an array of snacks out there and some drinks. So please do help yourselves to that just after this. And with that, would like to close today's session, and we look forward to hosting you again in the near future.
Thank you very much.